What's up everyone, it's Scotty with MoneyVest. So this is going to be a very quick tutorial and educational video on how to build your compound interest calculator, which is going to help you create an investment plan for yourself. So it's going to be in under 5 minutes. I'm going to make it super quick, super helpful, and sometimes some of the most simple, beginner-friendly videos tend to be the most useful and helpful videos because you can learn a lot and play around with the numbers and see what works best for you. So all I'm asking in return is that you drop a like on this video and subscribe to the channel if you haven't already. And the link to our Discord and Patreon is going to be down below if you're interested in joining and of course getting access to all the members only educational videos. There's tons more, tons more where this video is coming from. There's a lot more. And of course you get access to our MoneyVest Pro platform in 2024, our community on Discord, and a lot of other benefits, including TradingView charts, our individual stock reports, spreadsheets. Everything's going to be included. So link's going to be down below and we'd love to have you on board. So what we're doing today, Jesus, 1 second. Okay. Why is there a black? Oh my God. I was so scared. Oh my God. It's that thing right over here. I thought there was like somebody's hair. Holy shit. Anyway, okay, so this is you guys see this live reactions, right? I mean, this is wild. I mean, it kind of looks like someone's hair, right? Seems like, oh my God. Anyway, going over to the spreadsheet. So, what we have here is an Excel spreadsheet, right? It's just a normal plain spreadsheet. You can open up Excel. I'm going to show you and walk you through every single aspect of how to build this spreadsheet. So the first thing that we're going to do is that we're going to put down something called a PV, right? That's your present value. Okay, and I'm going to highlight what exactly this means. So this is going to be your initial investment. Okay, so that's going to be that number that's going to be represented as PV. Then this right here is going to be your contribution, right? Whether that contribution is each month or each year, we're going to put that over here, and that's going to be under PMT. That's also short for payment. This right here is going to be number of years that you plan to invest for, right? That's going to be N. And this right here is going to be your future value. It's going to be represented by FV, right? So FV is future value, PV is your present value, which is your initial investment that you're making. And this right here is going to be rate of return, and we're going to mark that as simply your R. So this right here are the things that you're going to put down in your Excel spreadsheet. And what we're going to do now, obviously, is make sure that the formatting is right. So we're going to hit these 3 cells, which is basically PV, PMT, and FV need to be in dollars. So we're going to hit dollars over here. N is going to be just general because that's number of years. And R is going to be the rate of return, which needs to be in percentages. We're going to hit percentage over here. Okay, so now you can get started with this calculation. Let's say that you want to start with $1,000. Okay, you've decided to start investing with $1,000. You're going to plug in 1,000 over here. Then you need to decide how much in contribution you're going to make every single month or every single year or every single quarter, whatever frequency works for you. Put in that annual amount, right? So this is something that you have to figure out. If you are making X amount of dollars and you're planning to save 40% or 20% of that gross income and investing that money, whatever that money is, annualize that, right? Multiplied by 12 and put that number over here. So to keep things very simple, let's say that you want to invest $500 per month into this portfolio. So you're going to put in $500 here. Then decide how many years you want to invest for, right? How many years is it that you want to be investing for in this example? Let's just say that you want to invest for 25 years. So you're going to put 25 here. Now, you can calculate for both. You can calculate for both future return, in other words, the future value, and you can calculate for the rate of return, right? You can do for both. I'm going to show you both how to calculate it. So in order to calculate the future value of your portfolio, you need to plug in the rate of return, the expected rate of return, right? So let's just say that you expect to earn 8% on average. That's the S&P 500 pre-tax over the last 100 years. That's been pretty nominal from the S&P 500. Let's just say that you expect 8%, right, from the S&P 500. Now, in order to calculate your future value, all you're going to do is come over to this cell, hit equals to sign, type in the letters FV. That's going to be the future value, and hit tab. And now it's going to ask you 5 things, right? It's going to ask you the rate, the NPER, that's number of periods. Then it's going to ask you the payments at the present value and the type, right? Compounding at the beginning or at the end of this cycle. Now, one more thing I want to mention is that we are going to put a minus sign in front of FV, right? We're going to put a negative sign over here. And the reason for that is because Excel, and just in general, this is calculated in terms of cash flow basis, right? So present value, if you are spending that money, in other words, if you're investing $1,000, that's cash flowing out of your bank and into your investment account. So in mathematical terms and from an Excel standpoint, it is a negative thing, right? It's moving out. It's a cash flow that's moving out of your bank into your investment account. So in order to compensate for that, we need to apply this negative sign when we're calculating our future value. So let's start with the rate, right? We already have the rate. We're going to choose this cell, which is at 8%, hit a comma. Then the next one is going to be number of periods, which is going to be this over here. That's the N. We're going to select that cell. Right now it's not showing because there's something blocking it, right? But that's the N. That's 20, 25 years that we've picked. Payment is going to be this right here. Now, the interesting thing is that you need to calculate the annual number. So we're going to open a parentheses or brackets, whatever you call it, 500 times 12, right? Because if the plan is to invest, let's say $500 per month, we want to look at it from an annual perspective, right? We want to look at what the contribution will be on a yearly basis, close the parentheses and hit comma again. And now it's asking for the present value, right? What's your initial starting point? We're going to go ahead and put $1,000. That's the cell that we're going to pick. Comma once again. Now it's asking compounding at the end of the period or beginning of the period. We're going to go with 0 because we want the compounding to happen at the end of every year. Close the final parentheses and hit enter. And now you'll notice that after 25 years of investing just $500 a month and starting with $1,000 will yield almost $445,000 in the future. Now, this obviously is not inflation adjusted. Okay, you can do that. You can inflation adjust this to present value, and there's another formula for that. For that, we have to plug in inflation, right? And for that, I'm going to, let's say I'm putting CPI as our term, and then I'm going to put in the present value, right? The new present value of that investment. So that's going to be the present value. Now, let's say that you expect inflation to be at 3% per year, right? This is also going to be in percentage terms. So we're going to come back over here. Put in the percentage. 3% is, let's say that you expect the CPI, in other words, the inflation to be 3% every single year. Now we need to calculate the new present value of this investment and what this $445,000 is going to be in today's terms, right? In today's terms, because we have to adjust for inflation. So now you're going to hit question mark, or in other words, an equal to sign. And instead of FV, we're going to do PV, right? Because we're calculating for present value this time. So we're going to go present value and hit tab. And once again, we follow the same process. Instead, this time, we're going to use a rate of 3% because that's the inflation rate that we're using. Hit comma. Number of periods, 25 years, because we're discounting back 25 years at a rate of 3%. There's not going to be any payments, so we're going to put 0% over here. And the future value is $445,000 because that's how much we're discounting back. And once again, we hit comma and finally 0 towards the end and close the parentheses and boom. This is going to be the value, and we forgot to put in the negative sign. As I mentioned, we have to put the negative sign next to PV or FV, otherwise it's going to be negative, as you guys saw. Hit enter, and this is going to be your investment amount following this entire plan. That's going to be the present value of your investment. 25 years down the road, if you follow this plan. Of course, there's a lot of assumptions that I'm making, but to give you an example and kind of educating you on how to calculate this on your own, and you don't really need a lot of calculators, right? A lot of that can be done with the present value, future value formulas. Now, I'll show you another neat trick, okay? Let's say that you are calculating for the rate of return, right? You have an idea on where you are currently. Let's say that you have $1,000, right? That's your PV. And let's say that you have a future value of, $1 million, right? Let's say that you want to earn $1 million in the future, right? You want to go from $1,000 to $1 million, right? And let's say that you want to do that in over a course of 30 years, right? So your N is 30. Now let's try to figure out, okay, what is it going to take to get to that level, right? What is it going to take every single year? How much you need to make in order to get to $1 million from $1,000? Let's figure that out, right? So let's just put in PMT first, and let's just put the rate of return required, right? The R is going to be the rate of return required to hit that goal. So now we're calculating for the rate of return. So in this example, instead of FV or PV, as we did earlier, what we're going to do is we're going to hit the equal to sign and we're going to type in the word rate, right? So now you get the rate, you're going to hit tab, and now it's going to ask you for different things. First thing it's asking is number of periods, 30, right? That's the number. Then comma, PMT right now is 0, and I'll explain why that is, and we can tweak that number. So right now it's 0, so we're going to select that cell. I don't have anything in that cell right now. Comma, once again, present value is going to be $1,000, but we want to put a negative sign in front of it, so we're going to put minus $1,000, right? So that's it, and we only need to do it for one number, right? Whether it's the present value or the future value. So comma again, and the future value, so now it's asking for FV, we're going to put in $1 million, right? Because let's say that's our goal, that's our target. Hit comma again and compounding at the end of the year. Close the parentheses and look at what the rate of return needs to be if you are only investing with $1,000. It's not going to be able to calculate because it's way too high. Let's see if I do $10,000 here. Now it's 17%, right? In other words, if you're starting with $10,000, you need to make 16.5% every single year for 30 years in order to get to $1 million. Now look what happens. Let's just go back to $1,000 because the number is so big, it's not able to calculate right now. But let's just say the payment, right? The monthly contribution is going to be $500. That's again multiplied by 12 because that is going to be on an annualized basis. We hit enter, and even right now there's nothing coming up because our target is too high, right? $1 million is too high. Let's just see what happens with $10,000 here. Now again, there's nothing coming up. Let me just fix this formula a little bit. D15, I don't know what's going on. It should work. All right, it's working right now. Let's just do $6,000 here. Yep, so something wrong with that. Yeah, something wrong with that $6,000. Let me fix that very quickly. There we go. So payment also needs to be in the negative sign, right? And the reason why there needs to be a negative sign, I just forgot, because it's also an outflow, right? It's also a cash that's leaving the bank and it's going into the investment account. So that's a cash outflow. And for that reason, it also needs to be in negative numbers. So if you go back to $1,000 here and of course invest $500 per month, now it's only under 10% in order to get to that goal. If I go with 25 years here, now it's going to be a little bit over 13%, which if you notice, the rate of return and the future value, of course, is going to be a little bit over $1 million. But let me show you something really, really interesting. If it's 445,484.11, then look at the rate of return. It's exactly 8%. Right? 8% that was calculated here because that's the future value, right? So what I did here, hopefully you guys followed along, is that I changed the future value to exactly the previous example, which we calculated for the future value. And in this example, we're calculating for the rate, right? So let me just highlight that. In this example, we're calculating for future value. In this example, we're calculating for the rate. And it's exactly 8% as listed previously because I changed the future value to being exactly this. Once again, if I put down the $1 million, let's just say that's the target, then the rate of return needs to be a little bit over 13%. So hopefully you got a little bit of an understanding. It definitely was not under 5 minutes, but I wanted to do this tutorial to kind of help you better understand. You can literally just go on Excel and create this on your own. It's free. It's, it takes less than a couple minutes to do if you're following along with the process and play around with the numbers, right? See what kind of numbers you can play around with, what kind of numbers you're working with. And I think it's really important for everyone, to basically have a financially fulfilling life in order to have these numbers and fully understand these numbers so you can, plan well. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe. As always, happy investing. I'll see you all in the next video.